For more stock news updates, remember to press the like button and subscribe. With that being said, let's get straight into the video. The artificial intelligence powerhouse, once celebrated for its meteoric rise, has seen a series of dramatic fluctuations that have left investors divided. The stock began the year with a noticeable slide, falling from a high of $75 to a low point of $64. Then, in a striking comeback, Palantir's share price surged, reaching a new peak of $124 on February 18th. However, that upswing was short-lived, as the stock has since lost nearly 30% of its value. At first glance, this level of volatility might seem alarming, but beneath the surface lies a business that is not only resilient but also arguably stronger than ever. Despite the stock's roller coaster behavior, Palantir's operational performance continues to reflect long-term potential. In fact, when we strip away the daily price swings and focus on the fundamentals, what we see is a company that remains deeply embedded in some of the most critical areas of government, defense, and enterprise software. Unlike many technology companies that depend on physical product sales or global supply chains, Palantir operates in a different lane altogether. Its offerings are rooted in software, specifically data integration and analysis platforms such as Gotham and Foundry. These platforms are digital, cloud-native, and built to handle complexity at scale. Gotham is widely used in defense and intelligence sectors, while Foundry is becoming increasingly important in commercial enterprises, helping companies manage and extract insights from vast amounts of operational data. These products have proven to be sticky, meaning that once organizations start using them, they rarely switch to alternatives. That is due to the highly integrated nature of the platforms and the depth of customization they offer. As a result, Palantir enjoys strong customer retention rates and recurring revenue streams. In fact, a significant portion of the company's revenue comes from long-term contracts, many of which are tied to government agencies that rely on Palantir's software for mission-critical operations. Moreover, while much of the technology sector has had to contend with issues like supply shortages, shipping delays, or tariff impacts, Palantir has remained insulated from those risks. This is because its core products exist in the digital realm, making them immune to the physical bottlenecks affecting other companies. During periods when other firms are slashing guidance or revising growth targets downward, Palantir has managed to sustain healthy revenue growth and profitability. Last year, the company reported cash flow margins of 40%, a figure that places it among the most operationally efficient businesses in its category. This is particularly impressive considering the company is still investing heavily in research and development to maintain its lead in artificial intelligence and data science. Additionally, Palantir holds zero debt on its balance sheet and boasts a sizable cash reserve. This kind of financial discipline gives the company flexibility to weather market downturns and make strategic investments when others are forced to retrench. Still, as with any investment, there are trade-offs, and for Palantir, the key sticking point remains its valuation. Even after the recent pullback, the stock is trading at a price-to-earnings ratio of roughly 290 based on forward estimates. In a macroeconomic environment where interest rates are elevated, borrowing costs are rising, and many investors are shifting toward value-oriented names, such a high multiple becomes increasingly difficult to justify. This is particularly true when market sentiment is fragile and risk appetite is low. That said, Palantir's story remains undeniably compelling. The artificial intelligence platform known as AIP is one of the company's most promising growth drivers. It's designed to help businesses automate complex workflows, improve decision-making, and accelerate time to value across a wide range of industries. From helping Wendy's streamline its supply chain to aiding aerospace firms with engineering processes, AIP is already being integrated into real-world business use cases. As more companies recognize the cost-saving and efficiency-enhancing potential of AIP, demand is expected to climb significantly. Indeed, commercial revenue from the United States is projected to rise by 54% this year, a sign that Palantir is successfully expanding beyond its traditional government roots into private sector verticals such as healthcare, energy, finance, and manufacturing. This transition from a predominantly defense-focused company to a broader commercial software provider is key to unlocking its next phase of growth. The company is also doubling down on innovation. Recent advancements in its artificial intelligence capabilities include predictive modeling and machine learning features that allow organizations to identify patterns, forecast outcomes, and simulate scenarios with unprecedented speed and accuracy. With artificial intelligence becoming a foundational layer of modern business operations, Palantir's positioning as an enterprise-grade artificial intelligence enabler makes it a strategic asset for clients across the globe. On the geopolitical front, ongoing conflicts and rising defense budgets in various parts of the world are creating tailwinds for Palantir's government segment. Nations are increasingly investing in advanced analytics and software systems that can help them manage data-driven decision-making in real time. Palantir is among a select few companies that are trusted to deliver such capabilities at scale. This trust factor, built over years of classified and sensitive work, gives it a durable competitive edge that is difficult for new entrants to replicate. So what should investors do with all this information? As it stands, the market remains divided. Some investors see the current dip as a buying opportunity, betting on long-term growth and sustained innovation. Others are skeptical, citing the elevated valuation and the broader market's increasing aversion to high multiple growth stocks. Meanwhile, many are taking a wait-and-see approach, preferring to stay on the sidelines until there is more clarity on both macroeconomic conditions and Palantir's execution. And honestly, exercising caution is not a bad strategy. Even though Palantir may appear like a fortress, financially sound, operationally strong, and strategically aligned, no company is completely immune to market pressures. If the stock price drifts lower toward key support levels, that may present a more attractive entry point. If it begins to rally, investors will still have access to a variety of artificial intelligence-focused companies that offer similar innovation potential, often at more reasonable price points. The bottom line is that Palantir remains a company worth following closely. Its fundamentals are impressive, its vision is ambitious, and its execution thus far has been commendable. Great businesses don't always make great buys, especially in environments where capital becomes more expensive and market participants become more selective. Sometimes the wisest move is to admire from a distance, do your homework, and wait for the right moment to strike. The artificial intelligence space is evolving rapidly, and Palantir is one of the few companies positioned to benefit meaningfully from that shift. Now, to address the most pressing question, is Palantir stock currently a buy? According to ratings compiled from 18 analysts, the consensus recommendation is hold. The average target price is $95.56, which implies a modest potential upside of approximately 3.86% from the current trading level. In the end, Palantir Technologies has experienced sharp price swings in 2025, rising from $64 to a peak of $124 before falling by 30%, yet its business remains fundamentally strong. Unlike traditional tech firms, Palantir delivers digital platforms like Gotham and Foundry that are insulated from supply chain disruptions and continue to gain traction across government and commercial sectors. With no debt, strong cash reserves, and cash flow margins of 40%, the company is financially sound. However, its valuation remains a concern, with a forward price-to-earnings ratio around 290, making it expensive in a high-rate environment. Still, its artificial intelligence platform, AIP, is gaining adoption across various industries and is expected to drive a 54% increase in commercial revenue from the United States this year. Analysts currently rate the stock as hold, with an average price target of $95.56, suggesting modest upside. For more stock news updates, remember to press the like button and subscribe. With that being said, I will see you in the next video.